Welcome. We're so glad to be with you here on this wonderful conference, and we have a really exciting panel. The conversation here is between Nick Fries, who's the Chief Risk Officer, Investment Risk for BNY Mellon Investment Management, John Galloway, Global Head of Investment Stewardship at Vanguard, and Julie Moret, Global Head of Sustainable Investing and Stewardship for Northern Trust Asset Management. I'm your moderator, Kirsten Spalding. I'm with Ceres, a nonprofit, and I manage the investor network of Ceres, a group of large institutional investors who work on climate change and other sustainability issues. So I'm just delighted to be part of this conversation today. And why don't we just kick off? I'll ask each of the panelists to introduce themselves and spend just a minute or so on why climate change matters to those you represent. Why don't we start with you, Nick?
Thank you for inviting me. So as you said, I'm Nick Fries, I'm the CRO for investment risk, essentially at BNY Mellon. That essentially means the CRO for the asset management business of BNY Mellon. As you know, BNY Mellon is a large asset manager with a multi-firm strategy to delivering these asset management solution. So I'm first of all, as a caveat or a disclaimer, I'm not by profession an ESG or climate risk specialist. I come to it more from a risk management angle. I've been a risk manager for more than 30 years in various positions, essentially market risk, but also investment risk at various firms, including JP Morgan, Deutsche Bank, and Citi, and now BNY Mellon. So I view climate risk as a new risk driver, which is emerging in the world of risk management, and it is a new and fairly distinct risk driver, which requires special attention because of all its, I would say, idiosyncrasies.
Yeah. And Nick, that's very consistent with what I'm hearing from a lot of our members, that climate is a risk. It's a unique kind of risk because it's systemic, not in a neat box necessarily, and hard to quantify, but a risk nonetheless. So we'll look forward to hearing more from you about that perspective. Let me turn to you, John, at Vanguard, you're head of stewardship. Why don't you introduce your perspective on why climate change matters to Vanguard?
Thanks, and thanks for having me. I'm the global head of the investment stewardship program at Vanguard. And at the high level, our stewardship program is focused on protecting the investments of the 30 million individual investors who've invested in the Vanguard funds. And we do it by encouraging the companies we invest in to follow strong governance practices and oversight of environmental, social, and governance risks, including climate change. And on this panel, I think I represent Vanguard, and in particular, the perspective of an index fund provider. Vanguard introduced the first index fund for individual investors 45 years ago. And today we offer about 300 index funds with around $6.5 trillion in assets under management in those funds. And I'm sure, as you and our audience knows, by design, index funds buy and hold companies for as long as the companies in the fund's underlying index, which means these funds can provide broadly diversified access to the global markets at a low cost. And that's why so many people have chosen to invest in them. But that broad market diversification also brings with it broad exposure to risks like climate change. It's hard to imagine or think of a company today that doesn't face some form of risk from climate change, whether it's physical risk to its operations or transition risk. And so we know that climate change risk is a very real financial risk to every long-term investor. And so we're focused on making sure that our portfolio companies are doing what they need to do to mitigate those risks on behalf of those long-term investors.
Thank you so much for that. Yeah, you said a couple things that seem really important to me. One, first, that you come from the engagement perspective and that you're focused on governance of the companies in these portfolios. And that seems to me like one of the key ways that we address climate risk is we engage with these companies and really try and make sure that well-governed companies, it's a core governance issue, are addressing climate risk in their operation. So we'll look forward to hearing more about that from you. Julie, would you like to introduce yourself and talk a little bit about how this matters to the people you represent?
Great, thanks, Kirsten, and delighted to be here on the panel. Really looking forward to the discussion. So I'm Julie Murray. I'm the Global Head of Sustainable Investing and Stewardship at Northern Trust Asset Management. We're a 1.2 trillion asset manager, well-recognized for specialist capabilities within quant sustainable investing and liquidity. With regards to sustainable investing and stewardship, approximately 155 billion of those assets are managed in a dedicated mandate with sustainable investment objectives. And with regards to the reason why we are focused on climate in relation to not just our end investor, but ourselves as investment allocators is quite purely and simply because of the financial risks that climate risk poses to asset impairment, asset valuations, but also, as John kind of touched on, it's also what you do with that information beyond the measurement, the management, the monitoring, but how you actually bring those issues up within the investing companies that we are invested in. And so the stewardship, particularly engagement and proxy voting, are the levers that kind of combined with the asset valuation component really makes for what we believe a holistic view on how we think about climate through a risk management lens.
So I think that brings us to the first sort of big picture question, which is how can asset managers mitigate the financial implications of climate change for valuation across various asset classes? And obviously, each of you have different perspectives on that, but maybe we'll start with you, John. The index fund approach is very different than those who are actively managing public equities or mostly engaged in private equities. So why don't we start with you? Just how is it you're managing this risk or mitigating?
Sure, thanks. So, yes, so as you mentioned, it's a unique role of an index provider, index fund provider, is that we focus primarily on the active engagement with the portfolio companies to look after any form of material risk, and climate change is high on that list. Right now, I think one of the challenges is there's no effective, consistent way for market participants, including Vanguard, to price the carbon risk. And we're well aware that the capital markets have never priced such a widespread systemic risk that's going to play out in unknown ways over the course of several decades. And so we know that Vanguard and other asset managers and market participants and regulators have a role to play alongside clear direction from policymakers and regulators to ensure that that companies are disclosing, are developing strategies for addressing the risks and opportunities related to climate change, for disclosing the strategies and the progress against those strategies over time. And we're going to look to policymakers and regulators to help create kind of the clear standards and expectations that we can then help our portfolio companies perform against.
Mm-hmm. Nick, I want to turn the same question to you, and I'll just note that in our prep work for this panel, you talked a little bit about the differences between those who are in liquid assets and those who are in illiquid or alternative asset classes. Maybe you can speak just a little bit about how you see mitigation of these risks in the different portfolios that you work with.
Yeah, I think a key challenge of climate risk as a risk driver is that it is a longer term risk driver than many other risks, or at least it's still perceived as a longer term risk driver than many other risks. So valuation is, of course, impacted both by the fundamental economic drivers that impact the cash flows we expect with an asset as well as the risk premium that is attached to that asset, and that risk premium is reflective of uncertainty associated against that stream of cash flows. So this is the theoretical principle that we've all learned either in textbooks or from experience. So then the next question is, how climate risk impact these two components? Of course, because it's a longer term impact, it affects mostly the fundamental economic drivers, but it will also impact the risk premium associated with asset valuation. And while that impact is generally intuitively thought to be experienced in the future, it is possible that we see an acceleration with which the marketplace acknowledges or factors in the impact of that risk premium, and I'll come back to what those drivers may be. So,
yeah,
I think depending for an asset manager, depending on the investment horizon, whether it's very long term or not, the management style, it's buy and hold versus more dynamic, active management, and of course, as a function of the liquidity of the asset, you need to focus more or less on one aspect or the other. But I think that even those managers who have a more dynamic management style, turn over their inventory more quickly, and deal with liquid assets, those managers also need to be aware of the impact that any change in perception of the risk may have on the risk premiums attached to the assets.
Mm-hmm.
So that's the general framework with which we try to look at those risks both in our asset management business, but also more broadly in the bank at BNY Mellon.
Yeah. I mean, it seems to me that we used to think about risks simply as market volatility, or not simply as market volatility, but is a complex way of considering market volatility. But with climate, there is both this opportunity to observe and address the risk, but also to actively be involved in shifting the risk as we engage with the companies and really begin to move with policymakers towards a low carbon economy. And Julie, I noted in your response when we were preparing that you said it's not so much about mitigation, but more about management of the risk. So maybe you can speak to that point a little bit.
Yeah, sure, absolutely, Kirsten. And so what we mean by shifting from mitigation to management is just the reality that, not all risks can necessarily be mitigated completely, but what we absolutely do have control of is how we manage those risks. And so this is management in terms of understanding what the vulnerabilities are. Of course, as well, identifying who are going to be the winners of tomorrow, kind of thinking future forward, those companies and businesses that are resilient to climate transition impacts, but also providing solutions. The other aspect, and this has already been touched on, is that the asset managers are one component of that whole solution and value chain. When we talk about climate change, we're effectively talking about climate transition risks, both policy, regulatory, physical risks. And in essence, we're talking about a rewiring of the entire economy. And so one can absolutely take some very practical steps as an asset manager to think through broadly, how do we begin to think through climate in both our asset valuations, our research, our modeling, as well as risk management, and how do we carry all that through to stewardship? In the way that I think broadly of those 5 steps are, well, first of all, I think one has to accept that we're beginning to see this real intersection between climate science and trying to understand what that means in terms of financial risk modeling. And so, one aspect is really, getting oneself much more informed, aware, and educated around climate science. There is, not only through academic partnerships, through industry initiatives, whether that's the PRI, whether that's Climate Action 100 Plus, or think tanks such as the Carbon Disclosure Project or Carbon Tracker. Mm-hmm. The next kind of 4 steps is, well, how do you then think through where your exposures are as a business? Take, for example, top 10 sector exposures that you have, and really focusing on those top 10 exposures and identifying which industries, which sectors are the most climate vulnerable, and really beginning to, as a third step, model out what are the channels of financial impact, both from risk as well as opportunities, that climate risk can translate into. Now, that means understanding and thinking through what that means for book value, what that means for the cost of capital, what that means for growth projections. Once you're able to have that framework, for us, the next component is how do we identify the data providers? There is a whole plethora, and I would say a growing plethora of data providers out there. And so I'm sure, like many of our peers out there, we use MSCI Sustainalytics, we use ISS, particularly the South Pole climate data sets. And so once we've identified the full range of data sets and some specialist data providers, beginning to identify what are the individual metrics that we want to begin to measure, that we want to begin to monitor and manage against. And the 5th step is really how you connect all that up and kind of switch on your stewardship toolbox through that engagement, particularly on those targeted companies on a risk-based perspective, and how you vote your proxies. And so, just to share out, typically at Northern Trust Asset Management, how we think about our climate toolbox is we typically identify some core indicators, and those core indicators are carbon intensity measures as captured by Scope 1, Scope 2. We then look at potential emissions that are embedded within balance sheets because that data is readily disclosed, available. But we're also a third core component we look at is a transition risk management assessment, which is really trying to understand and providing a measure on those companies in those industries that are the most vulnerable to climate transition risks, and assessment as well on how management is performing against those targets and those strategy. Looking at those 3 core areas, what we're doing is we're essentially giving a score to all the companies on their climate readiness, which then kind of goes into Northern Trust Asset Management's proprietary ESG vector score, which includes climate. And so, again, taking a step back, it's really for us, well, how do we first of all identify where our vulnerabilities are as a business? How do we identify the channels of financial impact? What are the metrics that we're going to focus on to monitor and measure those? But also, how are we taking those metrics and targets to the companies that we're engaging with throughout the year?
Many good points. Thank you, Julie. One of the things you highlighted was an early step of looking at the sector pathway, really trying to understand the science and identifying which are the heaviest emitting sectors, which are going to be the most impacted sectors, both, and then beginning to move with the data in the right trajectory. John, I'd love to hear whether that's also part of your stewardship work, whether you are taking this sector approach or whether you have a different way of identifying sort of where you engage around climate.
Sure. So, I think, as Julie said, we're very aware that the transition to a low carbon economy is going to be complex and nonlinear, and that there's and the regulatory and the market environment is going to continue to develop and evolve over time. And so we we encourage companies in our portfolio, and this is pretty much every company in our portfolio whose businesses and operations could be negatively affected by climate-related risks, to conduct climate scenario analysis to ensure that they have the proper processes in place, starting at the board level and then with the management, that they have the proper processes in place to mitigate climate risks and take advantage of climate opportunities over time. We're, as you and Julie just mentioned, we're aware that sectors will have different capacities for reduction emissions. Certain sectors like professional services, for example, will have a less challenging time mapping out their transition plans compared to obvious energy, utilities, and oil and gas companies. I think those challenges are sometimes lost within the discussion from some shareholders and advocates about how companies are going to navigate the complexities of reaching the Paris goals that we're all aligned to. We're not alone in that assessment. The scientific consensus, I'm sure you know from IPCC and the IEA, is that oil and gas usage will be significantly reduced by 2050, but not eliminated. And so we keep in mind that no two companies are going to trace the exact same path to 2050. Some high-emitting sectors will have a more shallow decarbonization pathway compared to other sectors, particularly in their value chains. And our engagement approach with companies is guided by that knowledge that it is going to be sector by sector and company by company. And we're looking for companies to provide both a qualitative and quantitative understanding of their strategies. And again, importantly, their progress, what scenarios they're working against, and that what their progress is against those scenarios over time.
It seems like this is a remarkably different exercise than what we were doing 10 years ago, that we're now not only asking what are your emissions? So a carbon footprint used to be the starting place, but now you've both said it's about transition planning. It's about the forward-looking, perspectives of the company. But the data there is tricky. Nick, do you want to speak a little bit about data gaps, things that are limitations as you begin to work with the portfolios to address things?
Yeah, so I think John and Julia are absolutely right to say that one very specific characteristics of climate risk is that there is a physical dimension and there's a transition dimension, and there may be also a representation or regulatory dimension to it, which is how is the market, the community, and the regulators agree on how to represent those factors, those risks, and the cost benefit of transition. The second thing I think it's also important to highlight, and it has been a little bit of a discovery for me in the last 12 months as I've put more attention to the theme, is that it's not only it doesn't really matter to have to just invest in the saints from an ESG perspective. It's important to help the sinners to redeem their souls and achieve a better position. And really, the challenge for the industry is to allocate capital to those industries, the sinners, and who can be salvaged, who have a chance for salvation. And that's a very important exercise and a very important responsibility. For that, in order to do that efficiently and also, fairly, we need better data to measure the cost of benefit across products, across industries, across companies. So I think what we have today is I think we have good measures of green gas emissions. We have a growing set of information on some corporations on how much they consume, but these metrics or these measures are very difficult to compare from one industry to the next, to one corporation to the next. And of course, the forward-looking measures of still need to be more standardized or more generally defined and accepted by the industry.
Yeah, this emphasis on transition planning and what that looks like. And as a priest, I'm always convinced that redemption is possible. So we do believe that these companies can move, and the question really is not can they move, but will they move with the speed necessary? Will they align with the goals of the Paris Agreement fast enough and appropriate to their industries, so that we can really begin to see the systemic shift towards the low carbon economy? John or Julie, either of you, speak to the data challenges as we try and help the companies in the portfolio move this way. What are you seeing, and how are you coping with them?
Great, I can jump in just with some additional thoughts, and what Nick touched on is really important in the sense that this transition story, it's really important to be cognizant that some of those high impact sectors, they are also going to be part of the solution going forward. And I always find it fascinating, when you think about energy transformations, it requires quite significant investments around the grid infrastructure to be able to support that transition away from fossil fuels. And so there's a huge, investment required both, and various of my peers on the panel have touched on this, through regulatory and policy. And so just, Kristen, if I may, just before digging into the details there, the regulatory and policy aspect is so pivotal and so important. And sitting here in London, what we've experienced and seen is Europe and the UK have been seen as progressive to the extent of introducing hard regulation, not just through something called the sustainable finance and the sustainable taxonomy regulation, which is really reorientating those capital flows to environmentally sustainable economic activity. But of course, in the UK, TCFD is going to become mandatory economy-wide by 2025. What that means for financial market participants such as ourselves is the regulation actually came into force at the start of this year, with TCFD reporting being made mandatory by June 2023. The regulatory and policy drive is, for all intents and purposes, part of trying to drive towards that clearer pricing signal on what is a mispriced risk, the global carbon price. Investors need a price to be able to kind of reflect that in valuations. And so part of the regulation, there is also the intent to also create, I would say, more precision and uniformity in the voice that the private sector takes in the investee companies, in really striving for disclosure around these more comparable, consistent metrics. And part of what we're seeing play out in regulation is a signal to drive towards that enhanced disclosure, not just through the regulatory push, I'd say, but initiatives such as the Sustainability Accounting Standards Board, TCFD, and of course the recent announcement by the IFRS around the International Sustainability Standards Board, which we think will be a game changer. So when you think about the policy and the regulatory backdrop, creating that system to provide clearer pricing signals as well as disclosures. When you look at the picture today, in terms of the biggest data gap, it continues to be around scope 3. And I think that's readily and increasingly well understood. And so if you take, for example, the constituents of the MSCI World, and you look at the composition of where the biggest exposures come from in terms of carbon emission contributions. So the MSCI World, approximately 80% of total carbon emissions of the constituents in the MSCI World are Scope 3. Ballpark 14% fall in Scope 1 and the remainder in Scope 2. When you also look at the magnitude of Scope 3 emissions relative to Scope 1 and Scope 2, they also vary by sector. And of course, the top three sectors there, where their total carbon emissions, a larger proportion of that is derived from Scope 3, are, no surprises, energy and consumer discretionary and industrials. And so when we ourselves look at where we're focusing our efforts and trying to do the modeling, there is a natural gravitation to really focus on those particular sectors and around the Scope 3, which is where Climate Action 100 comes into play. But again, just to put some of those statistics into perspective, when you look at Climate Action 100 plus, of the 159 issuers that are assessed, what we can see since the start of Climate Action 100 Plus is clearly a progressive movement around disclosures, clearly a progressive movement around governance, particularly around strategic oversight of climate risks within companies. What we do see as well, though, is approximately only 8% of those 159 issuers that are assessed are disclosing on all TCFD components and with transparency around decarbonization strategies, and that being specific to targets and metrics. And so really the takeaway from those observations is, number one, there's still a lot of work to be done, but that is very understandable given the scale of the transition and the implied business transformations required in certain sectors, but also that we will continue to see that shift away from policy and disclosures to really the implementation in terms of those targets and those metrics as well.
Yeah, thank you, Julie. A couple of things you said that I'd like John to pick up on, if you would. John, Julie mentioned some of the regulatory frameworks that are so important to improving disclosure in the UK and in Europe, the taxonomy being one. So I know we're waiting with bated breath for the SEC rule on the draft rule on climate disclosure. So if you have a perspective on that, that would be helpful. But then, Julie, you also mentioned the collaborative work that investors are doing within Climate Action 100 Plus. For those in our audience who are unfamiliar with that initiative, it's an initiative that Ceres and other global investor networks worked on, where we identified the heaviest emitting companies across portfolios in 5 sectors, developed a common framework for how we would benchmark progress with those issuers, and now are working with investors who are engaging those companies to really try and move in a concerted way, a shared set of priorities, a shared set of metrics, and beginning to be able to measure the progress in a forward-looking way. So, John, your perspectives on the regulatory, on the collaborative engagement strategies, but maybe even more generally on the disclosure gaps and what it is you're doing as an investor to address some of those with the companies.
Sure. So Nick and Julie have said well. The big challenge is the lack of agreed upon standards for disclosing climate risks at the individual company level or the issuer level. And while we are seeing greater adoption, and we think it's encouraging and helpful for frameworks like TCFD and to be getting increasingly regulatory backing, to continue the religious metaphor, I think we all agree. I think that the holy grail would be a clear and consistent global framework, akin to what we have for other elements of corporate accounting and reporting. We're a ways from there. I think both Nick and Julia alluded to the fact that one of the big challenges is Scope 3, which in many cases are the really material emissions for many companies, especially the biggest emitters, there's a lot of challenges in reporting Scope 3 emissions at this point. And we understand that. And we recognize that we submitted a comment letter to the SEC, and we spoke with other regulators about our views on this. And we believe that Scope 1 and 2 are largely table stakes at this point. But in our comment letter, we recognize that Scope 3 emissions, particularly in the less intensive sectors, or the lower emitting sectors, hasn't been figured out yet, and there's no consensus around this. And we recognize that companies have uncertainty about how to accurately measure and disclose greenhouse gas emissions, especially Scope 3, and that they have some legitimate questions about the risks associated with providing disclosures in the absence of clear regulatory frameworks. So what we're doing is looking to work with other industry participants, other asset managers, regulators, companies themselves, to make progress. So to not hold out for perfection in every instance, to know that this is going to be an evolving, it's a dynamic market, as I said up front. The regulatory environment is going to change, market expectations are going to change. And what we're looking for is companies to be proactively and constructively engaged along the way in providing robust disclosures about their strategies and the progress they're making against their targets. So we don't have a one-size-fits-all prescription, because we don't think that's the way the transition will actually work, nor do we think it's in the best interest of the long-term shareholders at any particular company, or Vanguard or another asset manager, to dictate a one-size-fits-all approach. But we are expecting that companies will provide, again, that robust qualitative and quantitative disclosure that's helpful for us to understand what is their plan to kind of create enduring shareholder value in an environment where, as my colleagues on this call have said, we expect there will be regulatory and market activity changes in order to get to the goals of the Paris Agreement. And we want to understand how companies, and particularly their boards, are overseeing their plans to continue to deliver shareholder value through that transition.
Yeah. I'm aware that we have 2 minutes and 30 seconds left in this robust conversation. So I'm going to just close by inviting any of the members of our audience, those who are participating, to join us in this work. Ceres Investor Network and our partner networks around the world are robust working groups on climate change issues, and we'd welcome any of you to participate with us. And I want to give each of you your last 30-second thoughts. Why don't we start with you, Nick?
So the lack of standards is a fact. It's a challenge. It's also a risk. And it's very important for, of course, investment managers and risk managers to understand that dimension, to learn as much as possible as what's going on, so that to understand how, of course, influence if possible, but first understand how these standards evolve and how they may affect the valuation and the risk in our various portfolios.
Julie.
Yeah, as John was saying, don't let perfection be the hurdle to start, and switch on your full toolbox, from data, measurement, management, monitoring, to ultimately what you do with that information, which is how you bring that forward with the companies that we're engaging with. So switch on the full toolbox, I would say.
Great. John?
In that, I'll build on Julie's to say, in switching on that full toolbox, we would encourage companies to understand why asset managers and other investors are looking for disclosure of the progress against their strategies, which is, in the case of a Vanguard, an index fund, we are the longest term of long-term investors, and so we're looking to understand how they're mitigating and managing these risks and seizing the opportunities related to climate change.
Fantastic. What a wonderful panel. Thank you so much, Nick, Julie, and John. I'm so glad we were together and able to just share these perspectives. Thank you to our audience who's joining us, and we look forward to working with all of you. Thank you to The Economist, and looking forward to the next session, which will start shortly. Thank you all.